Welcome to Cyber Explorer, your go-to channel for reliable tech insights and cyber trends. One of the most common questions I get, and maybe you've asked it too, is AI coming to replace my job? It's a fair question, and in the world of finance, it feels more urgent than ever. Today, we're not just talking about it, we're putting it to the test. We designed a real-world experiment to answer a simple but billion-dollar question. Who picks better stocks, a powerful AI, or a top-tier human hedge fund manager? AI versus hedge fund manager, who picks better stocks? Make sure you watch to the very end for the final conclusion and what it means for the future of investing. And I want to hear your take. Leave a comment below on who you think won before we reveal the results. The question of who picks better stocks, artificial intelligence, or human hedge fund managers sits at the intersection of finance, technology, and human judgment. For decades, elite hedge fund managers have been celebrated for their intuition, experience, and ability to interpret complex market signals. More recently, advances in artificial intelligence, AI, machine learning, and big data have challenged that dominance, promising faster, more objective, and potentially more accurate investment decisions. This debate is not simply about performance numbers. It is about what skill means in markets, how information is processed, and whether the future of investing belongs to algorithms, humans, or a combination of both. Understanding the two contenders, a hedge fund manager is typically a highly trained finance professional who uses a mix of quantitative models, fundamental analysis, macroeconomic insights, and market psychology to select investments. Their decisions are shaped by education, years of experience, access to management teams, and often a deep understanding of market history. They also operate within organizational structures, risk committees, and regulatory frameworks. AI, in contrast, is not a single decision maker but a collection of algorithms designed to learn patterns from data. In stock picking, AI systems can analyze enormous datasets, price histories, earnings reports, economic indicators, news articles, social media sentiment, satellite images, and more. Machine learning models improve over time by adjusting their parameters based on past successes and failures, theoretically becoming better investors as they process more data. Speed and scale of analysis. One of AI's most obvious advantages is speed. Markets generate vast quantities of data every second, far more than any human or team of humans can fully process. AI systems can ingest and analyze this information in real time, identifying correlations and anomalies almost instantaneously. They can scan thousands of stocks simultaneously, evaluate multiple scenarios, and rebalance portfolios with minimal delay. Hedge fund managers, by comparison, are constrained by human cognitive limits. Even with large analyst teams, there is a practical ceiling on how much information can be absorbed and interpreted. Humans must prioritize, simplify, and often rely on heuristics. This does not make them ineffective, but it does mean they cannot compete with AI on raw processing power. Pattern recognition versus intuition. AI excels at pattern recognition. Machine learning models can uncover subtle statistical relationships that are invisible to humans, such as nonlinear interactions between variables or recurring market microstructures. These patterns may offer short-term trading opportunities or help predict relative stock performance under specific conditions. However, human hedge fund managers rely heavily on intuition and judgment qualities that are difficult to encode in algorithms. Intuition often reflects deep, tacit knowledge built over years of experience. For example, a manager might sense that a company's management is overpromising, or that a market narrative is becoming dangerously one-sided. These judgments may not be easily captured by historical data, especially in unprecedented situations. Adaptability in changing markets. Financial markets are dynamic systems influenced by technology, regulation, geopolitics, and human behavior. AI models are trained on historical data, which raises an important concern. What happens when the future does not resemble the past? During regime shifts, such as financial crises, pandemics, or sudden regulatory changes, historical patterns can break down. Human managers may be better at recognizing when the rules have changed. They can reason analogically, draw lessons from distant historical events, and incorporate qualitative information that is difficult to quantify. AI systems can adapt, but only after sufficient new data becomes available, which may lag behind real-world changes. Emotional discipline and bias. One of the strongest arguments in favor of AI is its immunity to emotion. Fear, greed, overconfidence, and loss aversion are well-documented sources of poor investment decisions. Even highly disciplined professionals can fall prey to these biases, especially under stress. AI does not panic during market crashes or become euphoric during rallies. It executes its strategy consistently, based on predefined objectives and constraints. This emotional neutrality can be a significant advantage, particularly in volatile markets, where human decision-making often deteriorates. That said, AI is not entirely free from bias. Algorithms reflect the data they are trained on and the assumptions of their designers. If historical data embeds systemic biases or outdated relationships, AI models may perpetuate them. In this sense, AI replaces emotional bias with data and design bias. Transparency and explainability. Hedge fund managers can usually explain their investment theses, why they believe a stock is undervalued, what catalysts they expect, and what risks they see. This transparency is important for investors, regulators, and internal risk management. Many advanced AI models, especially deep learning systems, operate as black boxes. They can generate predictions or recommendations without providing clear explanations. This lack of interpretability can be problematic, particularly when large sums of money are at stake. Investors may be uncomfortable trusting capital to systems that cannot clearly articulate their reasoning, and regulators increasingly demand explainability in automated decision-making. Cost and accessibility. Running a top-tier hedge fund is expensive. Compensation for star managers and analysts is high, and firms invest heavily in research, data, and infrastructure. As a result, hedge funds are typically accessible only to institutional investors and high-net-worth individuals. AI-driven investment strategies, once developed, can be scaled at relatively low marginal cost. This opens the door to broader accessibility through quantitative funds, robo-advisors, and algorithmic trading platforms. While sophisticated AI systems are not cheap to build, their cost structure favors scale, potentially democratizing access to advanced investment techniques. Performance evidence. The ultimate question is performance. Who actually picks better stocks? The evidence is mixed. Some AI-driven funds and quantitative strategies have delivered impressive results, particularly in high-frequency trading and factor-based investing. They often excel in exploiting small, short-lived inefficiencies that are impractical for humans to trade. At the same time, many traditional hedge fund managers continue to outperform benchmarks over long periods, especially in strategies that rely on deep fundamental analysis, activism, or complex event-driven situations. Importantly, both groups also include underperformers. Not all hedge fund managers are exceptional, and not all AI strategies work as advertised. Risk management. Effective stock picking is not only about returns but also about risk. Hedge fund managers often think in terms of portfolio construction, downside protection, and tail risks. They may use discretion to reduce exposure when they believe risks are asymmetric or when market conditions feel unstable. AI systems can incorporate sophisticated risk models and stress tests, sometimes more systematically than humans. They can simulate thousands of scenarios and optimize portfolios for specific risk-return profiles. However, they may struggle with truly novel risks that have no historical precedent, where human imagination and judgment play a critical role. Ethical and systemic considerations. The rise of AI in stock picking also raises broader ethical and systemic questions. Widespread use of similar algorithms could lead to crowding, where many systems make the same trades simultaneously, potentially amplifying market volatility. Flash crashes and sudden liquidity shortages are often cited as examples of algorithmic interactions gone wrong. Human managers, while not immune to herding behavior, may be more diverse in their thinking and approaches. They also bear personal and reputational responsibility for their decisions, which can influence behavior in ways that algorithms do not experience. The case for collaboration, rather than framing the issue as AI versus hedge fund managers, an increasingly popular view is that the best results come from collaboration. Many successful funds now use AI as a tool rather than a replacement, augmenting human judgment with machine-driven insights. AI can screen opportunities, analyze data, and suggest trades, while humans provide oversight, contextual understanding, and strategic direction. In this hybrid model, AI handles what it does best: speed, scale, and pattern recognition, while humans focus on areas requiring creativity, ethical judgment, and adaptability to unprecedented events. This partnership can potentially outperform either approach on its own. Looking to the future, as AI technology continues to advance, its role in stock picking will almost certainly grow. Models will become more interpretable, data sources more diverse, and integration with human decision-making more seamless. At the same time, markets will evolve in response to these technologies, possibly reducing some opportunities while creating new ones. Human hedge fund managers will not disappear overnight. Their role may shift from pure stock selection towards strategy design, risk oversight, and the interpretation of AI outputs. The definition of skill in investing may expand to include the ability to effectively work with intelligent systems. Conclusion: so who picks better stocks, AI or hedge fund managers? The most honest answer is that it depends on the context. AI often outperforms in environments where speed, scale, and data-driven pattern recognition are paramount. Human managers shine in situations requiring judgment, intuition, and an understanding of complex qualitative factors. The future of stock picking is unlikely to be a zero-sum battle between humans and machines. Instead, it will be shaped by how effectively the two can be combined. In a world of increasing complexity and information overload, the most successful investors may be those who know not only how to pick stocks, but also how to choose and collaborate with the right intelligence, artificial or human. Don't forget to leave your comments below. Thanks for watching. Like, share, and subscribe to Cyber Explorer for more updates. See you in the next video.